Hello, everyone. Greyson here with SES Services, providing a weekly market update. Like to get some of the headlines from the financial news, go a little bit into depth. Today, we're going to talk about some of the erratic financial and economic data that we've had coming out over the last week. Okay, so not a big shocker here. Some of the economic data that's been coming out has been wildly erratic. I mean, even more so than it was previous to the last week or so. One of the big things that came out was the Chicago Purchasing Managers Index, which was an atrocious number, wildly lower than Wall Street was expecting. And it's just such a long-term indicator, is one of the things. People have been watching this thing for decades. And in the history of that index, Chicago Purchasing Managers, a reading as bad as we had, 37, I believe it was, a reading that bad has never not predicted a recession coming up. So absolutely a horrific number. Some of the housing data numbers are a train wreck. Now, of course, take that a little bit with a grain of salt because the housing market was so white hot in front of the last 6, 8, 10 months, with mortgage rates more than doubling from a lot of perspectives. And so the numbers that have come in just over the last couple weeks, few months actually, of pending home sales are disastrous. I mean, as bad as it's been since 2010, by some measures worse than at the dead of COVID 2.5 years ago. So these numbers look absolutely atrocious. And then the employment numbers came out at the end of last week, and they were really good. I mean, unemployment is still 3.7%. Two things to keep in mind with that. Number one, employment data is typically a lagging indicator. It's not so much of a predictive indicator, more of a lagging indicator. And also some people that really make their living off tearing through those numbers and really looking under the hood, dissecting, even auditing, you could call it, some of those numbers coming out of the Department of Labor. And the numbers from some perspectives aren't great. You know, we've mentioned this before in previous weeks. We've got second jobs, a lot of people taking second, even third jobs. So a lot of the employment numbers aren't new full-time career type employment jobs that would be indicative of a stronger market, but the numbers are still good. So it's hard to get too critical of it, but it's also hard to get too excited about it. But the funniest part about describing all this wildly erratic economic data, good and bad, coming out, you look at the performance of the market. And here's a picture of the S&P 500 futures contract for the last half of the year here. And we've had some big moves, as you can see. Really bad move at the end of October, or actually that's mid-October. But with all this wild economic data coming out, we've been pretty much going straight up for the last couple of months. We were fairly vocal that we thought the negativity was a little bit overdone when we were down in here a month or so ago. But now this is really interesting. So this is the 200-day moving average. And you can get too excited about technical indicators, looking at the price action of the market rather than looking at the valuations of the market. But the 200-day moving average is a big deal, because some of the money managers just use it as their indicator. And if we're above the 200-day moving average, by their charter, they might have to buy. If we're below the 200-day moving average, they might have to, keep some of the excess cash, keep some of the excess resources in cash rather than deploying it into the markets. So it's always a really big indicator. Pretty obvious the market wanted to go back up and touch the 200-day moving average. And of course, the question is now, where do we go from here? While I'm filming this, I think that we've got a pretty bad day going on in the stock market. But also consider the bond market. Quite a rally in the bond market over the last few weeks. We've got the 10-year Treasury which was holding ground well over 4%, almost all the way back down to 3.5% over the last few weeks. So some big moves in these markets. Of course, everyone is going to have their eyes on the Federal Reserve next week. The 14th is the end of the FOMC meeting, so we'll see what they say, because no matter what the economic data says, the Federal Reserve coming out and making their comments, bigger and faster moves when it's a Fed, one of the Fed governors making a comment about where interest rates are going. So right now the market is guessing we're probably going to do a 50 basis point rise in short-term rates. And on the other side of it, we have a wildly inverted yield curve. So if you want to talk about long-term indicators, Chicago Purchasing Manager Index, the yield curve being inverted, meaning short-term interest rates are significantly higher than long-term interest rates, and the Fed's going to raise short-term interest rates higher. Those indicators generally precede recessions, but people have been talking about that for a year now. So some really interesting times. Again, keep your portfolio well balanced. Anyone who needs, who feels like they've got too much risk in their portfolio, it's a good time after the S&P 500 has gone through the 200 day moving average. Some of the impetus to buy is gone. So if you need to lighten up, here's a great time. If you need help from us, just let us know. Reach out here. Our contact information is here. We will sit down with you, no obligation, to talk about your specific situation. But if you like the content, please hit like, subscribe, forward this content on to other people. I appreciate your attention, and we'll see you next week.